Welcome to Market Monday from the investment team and the trust department at the First National Bank. We're going to start today with what happened last Friday because it was pretty big news. We had the non-farm payroll report, which indicates how many, obviously, non-farm jobs were added to the economy in the month of April. And as highlighted in the survey, the expectation was about 185,000 jobs. That was the average in the survey. And the actual number came in much higher at 253,000 jobs, which, if we actually dig into the survey, was well more than two standard deviations above the average forecast. What that tells us is the labor market continues to be a lot stronger, probably than what the Federal Reserve would like in regards to its battle with inflation. So that, in and of itself, was big news. What was actually bigger news was that the market rallied very strongly on that, and interest rates did not really decline in a dramatic fashion after that news, which indicates that the market has taken it somewhat in stride, perhaps even is looking out at the possibility that inflation eventually does come under control, but it does so in that proverbial soft landing manner that the Fed was actually trying to achieve. Soft landing meaning, without recession, getting inflation under control. It remains to be seen what happens, and over the next couple of weeks, we're going to have more data points. That's key because at the last meeting, the Federal Reserve came out and said, look, we're going to be very data dependent. We're going to be looking at the numbers, and it may be appropriate to continue to hike the rates. So we'll see. Coming later this week, we're going to get the Consumer Price Index, which is expected to show a 0.4% rise, which is significantly higher than the 0.1% rise month over month of the prior period. The annual is expected to come in line at 5%, and the following day we'll get Producer Price Index, which is expected to have grown by 0.3%, whereas the last time it had shrunk by 0.5%. And that's important because what it indicates again is that there is a bit of a resurgence of these inflationary pressures. They're growing again, which might lead to further rate hikes down the line, and certainly in our view take off the table entirely the idea that there's going to be a rate cut in 2023. It just does not seem probable, particularly with the information showing a strong labor market in the face of the hiking cycle, along with the market action that remains relatively bullish. We get sentiment indications later on, retail sales, capacity, and manufacturing sector. More information on the labor market and sentiment over the next couple of weeks. All of these are data points that the Fed is looking at. But when we look at the market, this type of a pattern shows clearly that volatility is decreasing, and we're just kind of hugging an area, whereas before we were trading between that 3,600 and 4,200 range. Then it became 3,800 and 4,200 range. Now it looks like it's around 75-ish and 4,200. We're looking for a meaningful catalyst to take markets either higher or potentially back lower. And these data points could be those catalysts, or an eventual additional unexpected Fed rate hike could be a negative catalyst there. We're watching that pretty carefully. Like I said, bonds haven't really changed in a meaningful way. The yield curve is very sharply inverted, which would normally be telegraphing a recession, but none of the other confirmatory data points are actually confirming it. So at the moment, we don't really see the case for a recession, although it does appear that some of these indicators are slowing down, and we are expecting a call of recession at some point during this year. The big idea that's been gripping markets has been a resurgence of problems in the regional banking sector. So we thought it might be worthwhile to just take a peek at the, KBW Regional Banking Index, which shows what's been happening in that sector. And if you look out over 5 years, we are starting to trade down into the bottom area of their range over the past 5 years. Over the past year, the picture is a little bit more ominous. That was a bad day a couple days ago when we had First Republic, big in the news, and then we had other banks that were getting another run on them, Pac West, and there was another one. I don't really recall the name of it at the moment, but that appears to be under control. Pac West seems to be doing well. There was a rebound in the affected banks last week, and it does appear that these are going to be stronger going forward, that maybe there's some stability coming into the system. And what was driving this in different banks were simply concerns about the solvency of some relatively specialized banks that had either specialized client bases or were doing things with their balance sheet in particular ways that led to a potential for weakness. And it appears that short sellers got on board and just general market sentiment soured, saying, look, maybe these banks can't survive if there's a liquidity crunch. And those prophecies tend to become self-fulfilling. So the Feds, the government stepped in, and at that point, injected more stability into the system. And we've had a couple of bank failures that resulted, in either asset sales or sales of a bank to another larger institution. And stability appears to be resuming in the area. So back to the S&P 500, it looks like we're stabilizing and starting an upward trajectory. And, if we go back 5 years, we're looking like we might resume partially some of this uptrend. And our time frame is longer even than 5 years. You've seen us do this a lot. We're going to zoom out to 20-year time frame, and we see, even with the 2020 crisis, even with the 2008 crisis, this market has gone up by a compounded average of about 7.75% over the past 20 years. So, we zoom out, we take a bigger picture view, and we're in this for the long haul. We are advising, as we usually do, not to make changes to good long-term investment plans based on short-term market events, and to keep the longer-term view in mind. With that, if you have any questions, please reach out to us. Hope you've enjoyed the video. Thanks, and have a great day.